everybody? Ben Nelson here, the Everyday Real Estate Investor. Excited to come to you with another podcast episode. Thanks again for tuning in. Really appreciate the support. And again, I always try to reiterate at the beginning, my heart behind this is really, there's a lot of people that are really busy. We all have things going on. We have professional careers, we have family, we have hobbies and other things we want to spend our time on. But and there's a lot of stuff out there that's really great content, but it really pushes more towards the like full-time and owning thousands of units. And I'm not against that, and I think there's a lot of people that want that, and that's a goal. But there's also a lot of people that, you know, they want to figure out how to get in the game or maybe scale, and they've got other things going on. That's not necessarily their goal. That's what's pushed at them from what everybody else is doing or talking about, and just making sure that, you know, don't use those things as an excuse. Like, don't say, hey, I don't own anything. You know, thousands of units, that's way beyond me right now. I just can't even think about that. You know, let's dial it back. Let's know that we can incorporate real estate investing in our lives, and however, whatever scale that looks like is okay. You know, just decide that for yourself, and go out and make it happen, and don't use those excuses of being busy and all that stuff, right? So that's why we're here. And today I have an awesome guest. Grant Schroeder from Academy Mortgage is here with us today, and we're going to talk a little bit about lending options and the mortgage world right now. It's a little bit crazy. There's a lot going on, so I'm sure we'll have lots of good things to talk about. And talking about investor financing, because investor financing is definitely a little different as well. So thanks for being on the show.
Yeah, thanks for having me, Ben. Glad to be here.
Awesome. Well, why don't we start with talking a little bit first about your investment experience and just kind of your journey in that space, outside of just the lending side of it.
Yeah, so I initially got into real estate before I ever got into lending. Really just started with trying to eliminate my housing expense. I was paying $600-700 for an apartment, wanted to own my own place and eliminate my housing expense as much as possible, and started with house hacking. Bought a townhome, put 3% down as a first-time home buyer, rented out rooms to college kids, engineers, the guys I just played football with, and really just trying to wipe out my housing expense, and had a mentor recommend Bigger Pockets to me, and kind of the rest is history. I was hooked at getting linked in with the podcast and jumping on biggerpockets.com.
Awesome. Okay. So it started with how do I reduce my expenses?
It started with a frugal budgeting mindset. Yeah.
Awesome. Yeah, I think a lot more people start there than what other people think maybe, and I think it's a great way to start. And we'll talk, I think, a little bit more about that here, you know, further on in the podcast. But so where are you at today? I mean, if you don't mind sharing, so you bought one property, you own a couple, or you're renting them out now, or where are you at now?
So after the townhome, lived there for just a little bit over a year for the requirement for a primary. My wife Samantha and I got married summer of 2019 and went and bought a duplex, lived in one side, rented out the other.
Great way to do it, yeah. Awesome.
Kind of a compromise, having our own space, not living with roommates, but also still being able to build wealth through real estate and have a renter offset some of our mortgage and again limit our housing expense.
Awesome.
Kept the townhome, still have it today as a rent by the room student rental. Love renting to students here at George Fox University in Newberg. Went ahead and partnered with two other people to purchase another student rental even closer to campus shortly after buying the duplex. And then my wife and I now own our primary residence here in Newberg as well. It's kind of turned into a live-in flip. We kind of joke about lots of renovations with lots of value added, and so
those are fun. We've done several of those, so yes.
Yeah, so we're
awesome.
Really just three properties, 4 units, and
awesome. That's a great,
just kind of property or so per year, slow and steady.
Yep, slow and steady. And we talked about I mean, that's again going back to the thousands of units and like the big picture things. And again, I'm not against that. I think there's people that run their business that way, and that's fine. But talking to Evan Bellinger a couple weeks ago, very similar. He, very slow and steady, him and his wife Kim, in getting just a couple, 1 or 2 a year, and now they've got a pretty darn significant portfolio. So just putting those building blocks in place to be able to propel yourself to be able to grow bigger. That's a big part of it. So, but if you don't start, you can't put those first blocks in place. So
Biggest thing just being taking action one step at a time. I mean,
Yeah.
starting with your housing expense, starting with house hacking is the easiest way to get started.
Awesome.
So.
Well, very good. Well, let's jump into lending. Let's talk about lending and what is going on in the lending world. What options are out there for investors? But let's talk about like maybe what's current right now in the lending world.
Yes, I mean everyone's seen in the news. Mortgage rates have almost doubled from where they were at the start of the year. That really hasn't deterred a lot of investors. I mean, with inflation as hot as it is. I think we just came out, CPI came out at 8.6% last month, and it's projected to climb even higher to 8.7% this month. Real estate is still the best inflation hedge out there as far as assets go. We're still seeing lots of investors, lots of people house hacking, buying homes, and really the focus is not so much in the lending world. We're trying not to focus as much right now on the rate because that's where everyone's eyes go to. But
yeah, especially that sticker shock, right? Yeah, it's like, wait,
yes.
What is this? Like,
people who have been pre-approved or been looking for a year or just under that have been going through bidding wars and are just now getting under contract. The nice thing though that we are seeing is even with rates rising, with the market softening a little bit in certain areas, it's creating opportunities for people who are still taking action and wanting to purchase a home or purchase a duplex to live in.
Yeah, absolutely. Yeah, and that's what I try to talk to buyers that I'm working with a lot about is okay, yeah, your interest rate's a little higher, but you're also not having to go in and compete against 10 or 15 other offers and bid 10% above the list price and then like still not get it, right? So yeah, your rate and maybe your payment's a little bit higher than what it was 6 months ago even, but you're also actually able to get in on something and not have these crazy bidding wars and stuff. Yeah, so it's I would even say here in the Portland metro area, it's not quite an equilibrium market yet, but it's still very seller slanted, just not nearly what it was. We're so used to like this insanely seller slanted market where sellers could get whatever they wanted and like the list price was the starting bid, right? And we'll give you 3 months rent back without paying for it, and like all these crazy terms where sellers were just like getting whatever they wanted, and now it's kind of this. Now we're not getting that, so now it's a buyer's market. Well, no, it's not. it's actually like more equal. This is how it should be in a market, right? So yeah. Instead
of a property getting listed on a Thursday and being under contract with 8 offers by Sunday, there's a week or two that a home is sitting, and there's actually some negotiations that are actually
which is funny. Our memories are really pretty short, I think, because pre-COVID, that's kind of, I mean, it was still a pretty hot market, but it wasn't like COVID like pushed that forward, and like that's how we ended up getting in these massively like high bidding wars and tons of offers and everything. But and here we are 2 years later or whatever, and it's like we've forgotten that this is a normal market. So
and people, especially right now, even with rates higher, I mean, historically in a recession rates tend to come down. Now to see where inflation goes, that's a whole nother topic throughout the recession and introducing stagflation. But historically rates have come down, and it's much better for people. Okay, there's an opportunity in the market right now to purchase and to buy a home, to build equity, take advantage of appreciation, but also paying down your loan. And okay, say 2-3 years go by and rates drop back into the low 5s or into the 4s even. It's an opportunity to refinance and further stabilize your investment and save money.
Absolutely, yeah. And I think a lot of people's fear out there is, well, rates are higher now, and then if prices go down, like then now what do I do, right? Because a lot of people, either they've heard about or they've lived through, the financial crisis, and so that's the trigger that a lot. Oh my gosh, here we go again, right? So what's your take on that? Now, you weren't in the business at that time,
no.
but I'm guessing you still have some perspective on that, and just from being in the business. And so, what's your take on where we're at now?
In a typical market where you have that 3 to 5 months of supply,
and we just looked right before we got on this, right? Portland Metro is 1.4, so we're not even close, right? Yeah. Okay, I just had to bring that up real quick. So,
but if we can get, I mean, if you're in a place where you feel like you have fair balance between supply and demand, and sellers and buyers, that 3 to 5 months, kind of like we talked about in Investor Lab, interest rate in the past going up do have an effect directly on supply, and that's what a lot of people are pointing to. Yes, that is creating a little bit of a softening right now, but as you just said, we're at 1.4 months supply in the Portland Metro.
Yeah.
I'm licensed in other states, so I'm exposed to like Phoenix, Arizona, markets in California, Boise, Idaho, Spokane, Seattle, Washington, even out in like Nashville, Tennessee. You're still seeing a great supply shortage. Some markets you're seeing more inventory, but really it's really hard to see real estate values drop when supply and demand is still so out of balance. When people point back at 07, 08 and the drop in prices and the PTSD that people have from that, but we were 7, 8, 9 months of supply back then. We had a glut of supply where we don't even have close to enough right now.
Yeah, and I'd say lending is a lot more, I mean, you could speak to that better than I could. Lending's a lot more stable now, and I always go back to that when I talk about the financial crisis, that yes, ARM loans, there was all sorts of factors with the financial crisis, all the ARM loans and the supply levels and all of that stuff, but really what it came down to, a big part of it was illiquidity, right? There was no lending available. They basically, all these lenders closed their doors and everybody stopped lending money, and it's so you just make the problem worse. It's one of those self-fulfilling prophecies, right? Oh, we're in a recession, everybody stops, here's recession, so everybody stops buying, and lo and behold, we go into a recession because everybody's because you told them we were going to be in a recession, right? So same thing with that. It's you stop lending, you stop providing lending to buyers. Oh, we're afraid of a market crash, right? So we're going to stop lending, we're going to pull back on lending, and then you create that problem because people can't buy, right? So, which I'm not saying that, I think that's the one big factor that's, to me, not happening right now, but if it goes down that road again where lenders get really skittish, we could see that issue, right?
Yeah, and you saw that a little bit in March of 2020 when COVID hit. There were some lenders that shut their door. It was a liquidity issue again.
Yep.
But you don't have no doc, ninja loans, stated income loans like you had in 05, 06, 07. Credit is also, the credit profiles for Americans are so much better than where they were in 05, 06, 07, what led up to 08.
Yeah.
ARM's got a bad name, but right now, honestly, doing a 7-year or a 10-year ARM where you have a long window of time, if you can save 1.5% on a rate, that makes sense. But
that's a good point.
Guidelines are so much stricter and so much more well enforced. I mean, I get comments from clients where they have $1,200 that they owe on their taxes, and we have to verify. We have to dot our I's, cross all our T's in underwriting. We have to verify that's been paid to the IRS. We have to trace every deposit in their account. And yes, it's annoying, but it makes the lending world stronger because we are doing our due diligence. And when
versus the how much did you say you make? Oh, not 6, right? 10,000 a month? Yep. Okay, you're good. Yep. Yeah. No, I might be going a little extreme there, but it was pretty darn close.
You'd be surprised some of the stories.
Yeah. You said 10,000, right? Yeah. Okay. You're good.
We've even seen. As economic recession, we're right on the cusp for it officially being labeled with 2 negative quarters of GDP, and there are other recessionary indicators that are out there. But debt to income ratio is one of the first things to tighten, because as a lender, we're looking at 3 primary components when we're pre-approving. It's your debt to income ratio, your total sum of your, whether it's credit or installment or revolving debts like credit cards or auto loans, student loans, plus your mortgage payment versus your total gross income. That's one component. We're looking at your credit score, and we're also looking at your assets and your reserves. And right now, one of the things that is tightening up a little bit, you could see approvals at 49, 50% total debt to income ratio. And we're starting to see, depending on people's credit profiles and offsetting factors, some of the guidelines were getting a little bit tighter where you're getting down to 45% debt to income ratio. So the lending world is very much aware and is shifting as the economy changes to kind of offset any of that added risk.
Yeah, and it'll be interesting just to kind of add to one of the comments you just made about the recession that we're probably in, right? By definition, right? That typically in a recession, the interest rates come down, right? And yet we're in this environment where they're trying to get inflation under control. So what do? So it'd be, they're trying to fight two different things that have two very different courses of action, two very different levers that you pull. Like you pull this one to deal with this. It's kind of like dealing with multiple health issues, right? It's like, well, this is good for this issue, but it's bad for this issue that you have, right? So which one do you do? So okay, we're in a recession, pull back interest rates. Well, that doesn't help with inflation, right? So oh no, shoot. So now what do we do? So it will be interesting to see what they do to get themselves out of this corner.
What the Federal Reserve does. Yeah,
to this corner they kind of back themselves into. I mean, honestly, we talked about it before we got on the podcast here. That well, you said it, but I say it like every day right now. They were too slow to get to this point. So they had to go and do this huge ramp up. I mean, what were rates in February? 3% still, low
probably
3s?
3.5.
Yeah. So and then now we're 6, right? Somewhere in there. So that's a really short amount of time to go up to that. Now we should have probably been there now anyway, but we should have gotten there more slowly.
Yes.
We should have gotten there. Maybe we wouldn't have to be quite that high if they would have started a year ago or something like that, right? And start, which they said they were going to do, by the way. And then they never did.
Yeah.
I think they had, at the beginning of 2021, they projected doing 4 to 6 or something like that. Right? I don't remember it. I have to look back, and did they do any?
I don't believe so.
Yeah,
the first one was just in Q1 2022.
Yeah. So there you go. So probably should have done it sooner. They're smarter than me. I don't know, but that's just my take.
Yeah. The Federal Reserve they're slow to respond, and then they overreact.
Yeah.
They take it over the top. I mean, a lot of the printing, the $9 trillion of money they printed is creating more than half of the inflation we're seeing today. And their number one goal is to fight inflation. And where rates are based in bonds, and bonds hate that inflation, that's why we're seeing this rise in rates.
Yeah.
But at the same time, the economy, all these other economic indicators are going into recession. So when the Federal Reserve is kind of in between a rock and a hard place where, okay, when do you stop hiking rates? But if that doesn't actually curb inflation, are we going to continue to have the cyclical inflation of the 70s like we did until it was Volcker who kind of slammed the door in the 80s and finally put an end to it and really hurt the economy?
Right. Yeah. Yeah. So if you feel comfortable doing it, just you kind of touched on it a little bit. Without getting too deep into the weeds, bond market, all that stuff, and how that affects, because a lot of people don't really understand the basics of that, and it is complicated. It's a little complex, right? But,
and there are many points. I mean, I've been in the mortgage business for a little over 3 years. I've been very blessed to be with people who have 16, 17 years industry experience and learning from them and trying to soak up everything I can. And there's still elements that I don't understand, but the basic gist is that mortgage interest rates are based in bonds. It's called the mortgage-backed securities market. There's also there's an inverse relationship with the treasury note market, but in essence, bonds in the mortgage-backed securities market hate inflation. When inflation's running hot, you're seeing the yield on the 10-year treasury going up, and you see mortgage bond pricing going down, and therefore you're seeing rates head higher because inflation erodes the value of those bonds, and investors don't want to invest in bonds when they're losing their value so quickly.
Yep.
And there's lots of other things that play into it. But until inflation is really under control, we could continue to see rates climb higher.
So if you want to know where interest rates are going, watch the bond market and bond yields, essentially. That's the really, dumbed down version, but but yes, yeah, it is there. It's so interconnected, but there's reasons for how things react, right? Yeah, yeah. And then you could go further down, and sometimes rates price it in advance, right? Because they know what's coming, and just there's lots of
a lot of that rates. That's the investors on the secondary market that are kind of pricing in what the Federal Reserve kind of telegraphs what they're going to do. We could very much be seeing kind of a seesaw battle between, because bonds like bad news. So you see rates improve during poor economic times, during recession. If the Federal Reserve is telegraphing, or they actually follow through on what they telegraph with like a 0.75% rate hike to the Fed funds rate, bonds really liked that. So like that's why we've seen this improvement in rates to, I think Freddie Mac was coming out 5.3, 5.5% as a result of the Fed funds rate hike.
Yeah, which is interesting. It's because people. So this is where it goes back to people don't really, and I'm not going to say I understand all the intricacies either, but you see people say, "Oh, the Fed just raised the rate. Now rates are going up." Mm-hmm. Well, that's not what you just said, right?
No. So,
but that's what people say, right? Oh,
yes.
The Fed just raised the rate, and I see it all over social media and all over like. Fed just raised the rate. That means this is no. It actually doesn't mean that. Mm-hmm. But it's hard to understand. I get, but like people just make that instant connection. Fed funds rate. Fed's raising the rates. Now interest rates are going to go up, but it's almost opposite of that.
Yes, yeah. I mean it's a common misconception. I mean the media loves to shout, okay, the rate hikes. When the Fed hikes the Fed funds rate like they did, just 75 basis points. That directly affects your consumer credit. So like your home equity lines of credit, your auto loans, student loans, credit cards, anything that has a variable interest rate is directly impacted. I know if you're a consumer, you saw on your credit card, you got a notification from Chase or Bank of America within a week of that Fed funds rate hike, and it's, your APR is up 0.75%.
Yeah.
The Federal Reserve is hiking that Fed funds rate to increase the cost of borrowing, to slow down the economy and slow down inflation.
Yeah.
Because bonds where interest rates are based hate that inflation. They like it when the Fed is trying to fight inflation. That's why we saw rates kind of come down when they hiked.
Yeah. But so they hike the rate, bonds respond favorably for interest rates. And
yes.
And so then your interest rates actually go down.
Yeah. I mean, whereas when we saw the projections for the consumer price index just a couple weeks prior were supposed to be down down 0.1%, but it came in up 0.3% to at 8.6, and we literally saw rates, because it was unexpected. I saw rates jump 3/8 to 0.5% over a 24 to 48 hour period.
Ouch, yeah.
Just because inflation was running hotter than expected, and depending on how these next several inflation readings through the rest of the summer come out, we could kind of see this seesaw battle between, okay, the Fed hikes the rate, interest rates like that, interest rates go down, inflation comes out even hotter still, okay, rates start moving back up. There could be a lot of volatility through the rest of the summer.
Yep. Okay. So on that note, so two questions. So first question, what can people do in this environment with rates a little volatile and things like that? What are some things borrowers can be doing to be proactive in that as they're looking at their loan options, number one? And then number two, let's talk about some loan options, especially on the investor side. Maybe you have some really great investor-specific products at Academy Mortgage. So
I mean, really, people can. Start by again focusing on the monthly payment. But there are ways to do extended locks when it comes to new construction or longer closes. Academy has different programs where you can lock and go shop and try and find a home for like a 90-day period, so you're protected. A lot of times with new construction, we'll see 90, 120, 150 extended locks, even beyond protecting if there's any builder delays, anything like that. I mean, we had clients we locked in like January, February at like 3.75, 3.875, and they didn't close until May when rates were in the mid fives.
Yeah.
And they were ecstatic because we did that extended lock and protected them.
Yeah.
Academy Mortgage is a direct lender, direct correspondent lender. We're privately owned, so we have a few more tools in our tool belt than your typical bank or credit union. We can do conventional VA, FHA loans just like a bank or a credit union can do, but we can also portfolio loans on our own books, like one of the investor loans we'll talk about, and we can broker loans for more specialized situations like your debt service ratio loans, DSCR, bank statement, asset depletion loans. That is one of our niches is having those specialized products. One of the ways that not only in service but also in the products we offer, we can set ourselves apart.
Also, yeah. So on that note, this is like, as an investor, whether you're just starting out and trying to figure out what your options are and what do I want to do, what's my strategy, what can I qualify for, I talk a lot about your team, and a good mortgage broker is, I mean, worth their weight in gold because, you know, you can go to an individual lender, you can go to a bank, right? But they're going to have really limited options. And I'm not saying you shouldn't do that. Like if you're a cut and dry borrower and you're going to buy your personal residence, okay, I mean, maybe. But if you really are trying to be an investor and like know and be strategic and know what your options are, and not even just with your first purchase, right? With like looking down the road, here's what my goals are. Having someone that can, you know, you have your realtor that can help you do that and help you find the product and run the numbers and you know, buy something that has the returns you're looking for. But the loan is a big piece of that, and the financing you put in place, and so it can make a huge difference on what you're able to buy and what the numbers look like, and then what your next one looks like. And you can really shoot yourself in the foot if you don't do it the right way right up front. But yeah, in starting that process early and talk, hey, here's what I want to do, here's my goals, you know, having them look at your financials, and having them come up with a game plan for you and figuring out a strategy is huge.
And that's, I mean, this business is all about long-term relationships. I love working with past clients over and over again, building their rental portfolios. That is the biggest compliment when someone refers their friends and family. Like, that makes my day every single time. But we are more than just, like, you can go to an online lender, they can quote you a rate, and that's about all they do. We call those order takers.
And I was just gonna, and that's a big difference. And I think when you're calling around, if you're not connected with somebody like Grant, and if you're not in an area where Grant does business, you make a few phone calls, and if they try to get to your like credit score within the first 2 minutes of your conversation, and like, hey, we need to pull your credit. I mean, I've literally talked. Well, all they want to do is pull my credit. Don't talk to them. I mean, that's my opinion. But they're short term, right? Like, can this person buy right now? Can this person buy right now? And it's very transactional. Yeah, it's just like, can they buy right now? If they can't buy right now, I don't even want to talk to them. And there's realtors like that. There's lenders like that. I've talked to buyers for 12, 18 months before they have bought. And I'm sure you've done the same thing on the lending side. It's like, you have to be willing to walk. You need to work with someone that's willing to walk through that process with you. And if you're not in that position, or you're not ready mentally, or you're still trying to figure out help, you know, you're being a consultant almost too, right? So
a lender is so much more than just a rate and a cost on a sheet of paper. We are mortgage consultants, like you said, where I will sit down with someone. Like, I just had 2 clients within the past month that we've been working with them for 12 to 18 months, and they've been persevering, they've stayed the course, and they got under contract. But I will sit down with people. Like, my first phone calls with people are usually 30 to 45 minutes. Yes, it's time consuming, but I'm not just asking for someone's credit score. Like, I want to get to know them as a person. I like, what's your story? Tell me a little bit about yourself. What are your goals? Like, what do you see for the long term? Because that, like I was saying, this is a long-term relationship business, and I want to help them build wealth through real estate, build prosperity. Like, I will sit down, especially for self-employed clients and people who own rental properties, own multiple businesses. That's one of the ways we set ourselves apart, getting into the weeds, getting into the guidelines. Like, I have a lot of clients that come February, March, April, when their CPA sends them a tax draft. Before they file, I will go through and look through and say, hey, here's what your qualifying income looks like if you file like this. If you're wanting to buy 1 or 2 properties this year, okay, maybe you tweak it just a little bit to maybe you pay a little bit more tax, but you show an underwriter you have a little more qualifying income, so we loan optimize you and IRS tax advantage you.
Absolutely.
There's ways. There's a strategic game plan for the long term.
Well, and so here's the thing. Let's be real. Anybody can take a phone application and run credit and run a few numbers and say, here's what we qualify for, right? I mean,
automated systems.
The big lenders have people that aren't loan officers. Essentially, I mean, they're phone receptionists.
Yes.
Call
centers.
They're call centers. Yeah. So anybody can do that, right? So you don't want someone like that as an investor. You want someone that's going to walk you through that process. Same thing on our end, right? I can put a sign in a yard and put something on a listing service. You know, any realtor can do that. Like why me? Why any realtor? Well, are they consulting you? Are they coming? Hey, why are you selling? Especially as an investor, if you're selling a rental property, well, okay, why are you selling, and what are you wanting to accomplish by selling, and what are you wanting to exchange into, and trying to figure out the best way to maximize your investment. I mean, you're doing the same thing on the lending side, but yeah, I mean, anybody can do those simple tasks if that's all your professionals are doing for you is the basics. I mean, you should find someone else. I mean, that's the bottom line. Find someone that's doing those extra things for you and being that consultant. So let's talk about a couple of the specific loans just really quick. We didn't touch on those yet, have we?
Yeah, we haven't.
Okay. Talk about a couple of loans. Yeah, let's do it.
One of the ones that I've helped a lot of investors with, whether they're getting started or they're trying to scale their portfolio, is one of the loans we portfolio on our own books. It's called the Academy Investor Loan. For a Fannie Mae, Freddie Mac, like a conventional loan, you need to put 20% down on a 1 unit, and you need to put 25% down on a 2 to 4 unit.
Yeah.
With our Academy Investor Loan, you can put 10% down, no mortgage insurance. It's a 30-year fixed, just like a conventional conforming loan. But typically our rates are also 3/8 to 0.5% better than wherever a conventional loan is at 20 or 25% down.
So what are rates range ballparkish looking like on that?
Yeah, so with that loan, you're probably around 5.75 to 5.875 right now versus conventional, you're probably looking mid sixes, 6.375.
So wait, so lower down payment, no mortgage insurance, and a better rate. Sign me up for that. Yeah,
and it's a conventional loan as well. I mean, when you're writing an offer as a realtor for your client, it is a conventional offer. We're still looking at debt to income ratio, credit score, assets and reserves, just like for a loan that's going back to Fannie Mae, Freddie Mac. But because we keep it on our own books, we can offer lower down payment options and lower interest rates.
Yeah, that's awesome.
Not tied to that.
Yeah, and market. For most investors, not all, love leverage, right? So as long as you leverage as much as you can, so you can buy more, as long as you can still control the debt with the cash flow. Yeah. So that's a huge difference. You can buy 2 properties instead of 1, right?
We see that a lot with 1031 exchanges.
Like, holy cow.
Someone who thought they were going to have to put 225 down, just have 1 replacement property. They're like, wait, I can put 10 down and I can leverage my equity and buy 2.
Buy twice as much real estate. Absolutely. Yeah. And that's how you build long-term wealth with real estate, is own as many assets as you can that are producing income for you and that are paying for themselves, right?
Yeah.
Yeah. I'd rather be, $5 million in debt than $1 million in debt, right? Because if I know that is paying for itself. Yeah. Awesome. So that's a great one. Obviously, low down, good interest rate, conventional loan. So that's great. What else do you guys got?
One that we've talked a lot about. We have a one-time close typically it's just a primary residence right now. At one time it was investments. There's been a little bit of fluctuation with that, but primary residence, you can put as little as 5% down and purchase, instead of having to buy a land cash, or a lot of banks will require you to put 25 or 30% down. You can buy the land plus your build costs all into one, and it's a 5% down conventional loan. It's a one-time close product that's specific to Academy.
And that's a great loan for builders, developers to be turning people towards too, right? So now they don't have to build the product necessarily and spec build it, and carry those costs and hope there's a buyer on the other end. They can basically pre-sell it. They get cashed out up front essentially, and then now they can do more because now the buyer has basically already bought it and is just waiting for it to be produced.
They can deleverage a little bit quicker and continue to put up more units.
And it's a buyer. A lot of buyers have. Your buyer pool is pretty big with 5% down minimum. So that's great.
People get scared away from new construction because of needing 25 or 30% down. It's kind of daunting. You have to sell a residence or something to have the equity to put down. Yeah. One of the other ones, we can, as at Academy Mortgage, we can broker loans for, like I said, the more specialized situations, like your DSCR, debt service coverage ratio loans, which functions almost more like a commercial loan, where it's just based, you're looking at, there's personal guarantee where the rate is based off of your credit score, but it's just based on the income production of the property, where gross rents just have to equal 1-to-1 with your PITI. You have a lot of BRRRR investors that use that. I mean, there's options. You can do a 30-year fixed on it, but there are also options to do a 40-year term where you have a fixed rate for those 40 years, but the first 10 are interest only, and then the remaining 30, it's amortized over 30 years, all at that same rate.
And do they use that interest only payment for the debt service coverage ratio, or so you potentially could take one, again, make sure you're doing it strategically and not just over leveraging, but you potentially could take one that is a little bit tighter on the cash flow now. Maybe you're gonna do something later to add some income, so like, hey, I'll be good, but and you can use that lower interest only payment to qualify for the 1-to-1 ratio. Yeah. And
no, I mean, you see that with a lot of BRRRR investors where maybe they'll renovate one side of a duplex, but they've inherited a tenant in the state of Oregon where you're capped at how much you can raise rents. That not only does it help that interest only help them qualify up front with the debt ratio, but as they're stabilizing the property and raising rent over time, conforming to what Oregon caps you at, they can still cash flow on the property and be a good investment.
Yep. And then when it transitions to that amortized payment, then
property's fully stabilized by that time. Yeah,
absolutely. Awesome. Those are some great programs. That's awesome. Yeah, and I mean, that's again where talking to a loan broker such as yourself to, what are those loan options and which ones do I qualify for? Kind of hard to go out and put a deal together if you don't even know what your financing options are. So a lot of people want to, they get excited about the deal and finding the property and this works and all that, and then they forget about they get the cart a little bit ahead of the horse, right? And now I got to figure out financing. Figure out the financing first.
Always best to get pre-approved first. Know what you're approved for. Know what your options are. Have a game plan. I mean, whether that's take down one property or two in a year, knowing what you're approved for, like you said earlier, like buying that first one based on how it cash flows, how the numbers work, might limit you debt to income ratio wise from buying that second one.
Yep.
And let's not forget about your traditional, your FHA and your VA loans when people are house hacking.
Yeah.
I mean, there are options. If someone's buying a single family home, they can do 3% down conventional as a first time home buyer, just like I did my first time. But we're starting to see more your 3.5% down FHA loans and VA loans win on duplexes right now, where the past 2 years listing agents were kind of saying no because there's not a ton of difference underwriting wise from a conventional loan, but there's a few added like inspection things. They're looking in the attic, they're looking in the crawl space. But if the property is cosmetically semi-clean, there's still lots of opportunities and more with this market as it changes for those buyers trying to house hack.
Yep, definitely. Yeah, and I would say as far as the market, just the one last little thing on the market, I think lending's always looking at where the market's headed, right? Because ultimately, you as a buyer, you're on the hook, but the lender is just as much as they're sharing the risk with you, right? So if lenders aren't concerned about the market, I mean, that's just an indicator, right? As far as if lenders are feeling pretty good, they're still doing 10% down on the that's pretty aggressive. For on an investor loan. I mean, like you said, normally it's 20-25%, so 10% down. So as long as you're seeing stuff like that out there, I still feel pretty, they're looking at all those things too about the economy and markets and all that too. So if they feel like they're at risk, they're going to start pulling that stuff back. And there's lots of different, like you look at the big players and you look at all the people that are involved in the industry, and you can kind of get a sense of how everybody is feeling about where housing is headed, right? So.
And you will see we've already started to see it over the next 6 months. You will see some lenders go under that failed to keep liquidity or got over bloated with staff or operations during the refinance boom.
Yeah, I know, and that's what I've had several people point, look at these people closing their doors, and look at the number of applications, and look at the number of loans, and it's like, well, yeah, but like 70% of them were refinances, so it makes sense. And that's not actually producing anything really. It's just recycling money and moving paper. It's not actually moving product or anything like that. So no offense to refinances, but
No, I mean, a lot of lenders they load up. The industry is very cyclical. Like you saw a refinance boom in 2016, you saw it in 2021. People they load up on staff, and you see lenders letting people go, lenders shutting their doors. But there are a lot of the bigger players like Academy right now. I mean, we are very liquid from a corporate standpoint. Like we're actually actively looking to acquire companies and merge.
Yeah, that's great.
There's a lot of companies who have been smart with all the. It was awesome. It was plentiful the last 2 years, and it is harder now. But really, at Academy, we flipped to being more focused, like probably mid to early 2021, on just purchase business.
Yeah, which was
because that is sustainable.
Maybe saw the writing on the wall a little bit, but yeah, I've seen a couple projections where purchase mortgages were actually trending up versus you have to be careful. Headlines and data points and all of that stuff, if you pointed to just mortgage applications, like overall, it would look horrible right now, right?
It's down to 2008 levels.
But oh my gosh, now here we go again. Well, okay, that's one piece of data, so you got to look at all the other pieces and see where it fits in the puzzle before you draw a conclusion.
The media gets paid to grab eyeballs with headlines, and a lot of the data is misinterpreted, and so I mean, people listening to this, if you see a headline like that, call your realtor, call Ben, call me, ask, and we'll walk you through. Okay, this is what the data actually says. This is they'll point to the headline one way, but here's actually what's going on.
Yeah,
and the media's not telling you.
Yeah, and in my market update videos and stuff that I do, I always point to that too. Like you take a headline, and then if you actually read the article, it doesn't even say what the headline says. There's like, well, the headline says this doom and gloom headline, but then in the article itself, it's like, well, actually no, because this and this. But if you just read the headline, which 80% of people do, it's like, oh my goodness, right? So that's why you actually have to read the article, and then not to mention the fact that, a lot of those, they're journalists. They're just regurgitating information, right? Yeah. They're not economists, most of them, and so they're drawing a conclusion that may not be true because they're not really qualified to draw a conclusion, right? Yeah. So
they're getting paid for the number of clicks on their article.
Yeah, exactly. Well, anything else you want to add about the lending world or loan programs or anything like that?
You said, mortgage applications are certainly down, but I mean, personally, like, we are seeing growth. We're seeing, I love, like I said, working with past clients, referring people over. Like, we're seeing a lot of applications. It's just right now, it's still tough. Like you said, it's still very much a seller's market from every statistic out there. There are more opportunities being created for those who are taking action and being diligent through the process. Yeah. Submitting offers that will win, working with their broker to set themselves apart. And really, I guess the last point I'd add, one of the things that has helped set me apart with a listing agent, I will call the listing agent when my client submits an offer, and I will walk them through the financing. Like, I just had probably 2 months ago in Portland, I had a client very well qualified make an offer with a VA loan on a duplex, and the listing agent wasn't too sure about it, and I talked with him, walked him through the financing, what would happen on the inspection, and just kind of affirmed how well qualified this client was. And I got a call from the buyer's agent I was working with, and he said, hey, we were like the third offer in terms of price point, but after you talked with them, they accepted the offer.
And that is what your team members should be doing for you. Absolutely. That's awesome.
Yeah. In a competitive situation, I mean, that can
make
all the difference.
Extra phone call to sell the loan and to sell the buyer, right? Mm-hmm. And that's how you get your offer picked. Absolutely. It's awesome. So on that note, if people are looking you mentioned some of the places you lend in earlier, how do they reach out to you and find out more about where do you lend, more about these loan programs, that sort of thing?
Yeah, you can reach...
Or just to connect because you're a cool guy. So, I mean,
I'm glad to talk strategy and game plan anytime. I love talking about real estate, running through the numbers. But you can reach me at 541-231-1256 or grant.schroeder@academymortgage.com. There's also a link with loanswithschroeder.com. I'm on all the social media.
You're on Bigger Pockets a lot.
Bigger Pockets. Love being on Bigger Pockets.
I don't mind saying another podcast on here. It's cool. Awesome.
Oh, yeah.
Well, thanks for being here. Thanks for sharing your insights on the market and some of the awesome options that are still available for investors. And hopefully that's helpful to people listening. And again, just recognizing those opportunities that maybe you didn't know were out there. And hey, I've got to save another 50 grand before I can buy a rental property. Well, maybe you don't. Talk to Grant and find out. So.
And whether you're looking in Oregon, I don't know if I mentioned all the states that I'm licensed in. We might have kind of brushed over.
I think we brushed over. Yeah.
I am physically in Oregon, but because through Bigger Pockets, through connections with clients, I'm licensed in Washington, Oregon, California, Arizona, Idaho, and also out in Tennessee. That's a kind of a Bigger Pockets thing way out there, but. Love to network with people in multiple states, and our lending guidelines and products are available in all those states I'm licensed in pretty much. So yeah, glad to help people from afar or up close.
Awesome. Well, thanks for being here and appreciate it. Thanks everyone for listening, and we will catch you on the next one.
Thanks, man.